Welcome back to the deep dive. Today, we're getting comfortable and taking a trip into the financials of, well, comfort specifically, the LZB fiscal 2026 second quarter earnings call.
That's right. And we've sliced through the prepared remarks to focus exclusively on the numbers, the breakdown from the senior VP and CFO.
So what's the mission today?
The mission is to really understand their Q2 performance, but maybe more importantly, to dissect the big strategic moves they're making, these Century Vision initiatives.
Right, they're making some really serious structural decisions.
Exactly. And the numbers, they tell us if those decisions are paying off or, just costing them a lot of money in the short term.
And the high-level snapshot, it kind of shows a company that's holding steady in what they keep calling a choppy market.
Yeah, that's a good way to put it. Consolidated delivered sales for Q2 came in at $522 million.
Which is a slight increase year over year. And the adjusted operating margin?
It settled at 7.1%. So on the surface, it looks, pretty flat. But if you dig into how they actually got to that 7.1%.
That's where the story is.
That's where you find this fascinating internal battle playing out. It's absolutely a story of offsetting forces. The consolidated adjusted operating income was $37 million, which is respectable. But it really required the wholesale division to work overtime.
To cover pressures from somewhere else.
Precisely.
Okay, so let's unpack those pressures first. Where was the financial drag most noticeable?
The drag was, it was clearly visible in the retail segment. They had what's called retail margin deleverage.
Right. Explain that for us.
Essentially, the fixed costs of just running their stores, the rent, the lights, the overhead, it all weighed more heavily on their profits because delivered same-store sales were lower.
And on top of that, they're investing, right? Opening new locations.
Aggressively. And those new stores, they drain resources before they start bringing in any real revenue.
So the retail network is absorbing costs today for market share they hope to get tomorrow.
That's the play. It's necessary spending, but it definitely eats into the margin right now.
Okay, so if retail was soft, what was the massive lift that came to the rescue?
The lift was the wholesale segment. And this is where we have to be really specific about what was driving it.
It wasn't just them selling more recliners.
No, not entirely. The strength was partly organic, good operating trends, but it also included a very significant and I'd say non-recurring financial benefit.
I think I know where you're going with this, the warranty factor.
Exactly. The wholesale margin improvement included a crucial 110 basis point benefit.
110.
And that was derived entirely from a change in their dealer warranty arrangements during the quarter. They basically moved from one accounting structure to another, which just instantly reduced their liability expense.
Wait, hold on. 110 basis points. That's over a full percentage point of margin improvement that came from a technical accounting change.
That's right.
That's not from selling more furniture or making factories more efficient. As analysts, we almost have to set that aside, right? Treat it as non-core.
You absolutely have to. It's a cleanup, not a repeatable operational gain.
Yeah.
But it certainly did the job of propping up the consolidated margin for Q2.
Okay, but even taking that out, they still found some real efficiencies, didn't they? What about input costs?
They did. Consolidated adjusted gross margin actually increased by 10 basis points. And that was primarily organic.
So where did that come from?
Mostly lower input costs, specifically favorable ocean freight costs finally flowing through, and just better sourcing in general.
The declining global shipping costs. It's the gift that keeps on giving for so many companies right now.
It really is. But that 10 basis point gain, it wasn't all pure gravy. There was a costly flip side to it.
And this is where their big project comes in.
It is. This is critical to understanding their long-term plan.
Yeah.
The supply chain friction costs. That gross margin gain was partially offset because they are deep in this massive distribution and home delivery transformation.
The one where they're consolidating from, 15 distribution centers down to just 3?
That's the one. An incredibly complex project.
So when the CFO talks about friction costs, what does that actually mean on the ground? Is it just paying people overtime?
It's so much more than that. I mean, friction in this case means you have inventory in the wrong place, you have higher shipping costs as you reroute everything, you're training new staff. It's managing all the overlap.
It's planned short-term chaos.
It's exactly that. Short-term chaos that costs a lot of money today, but the promise is a much leaner supply chain tomorrow.
So you've got this tailwind from the warranty change and freight costs, but a big operational headwind from their own transformation.
Right.
And at the end of it all, adjusted diluted EPS landed perfectly flat year over year at $0.71.
Which tells you is a highly managed quarter. Every gain was pretty much immediately consumed by either transformation costs or those necessary investments in retail. A quarter defined by management balancing.
Let's dig into that engine room then, the wholesale segment. If we ignore that one-time warranty benefit for a second, what did the core performance look like?
Wholesale delivered sales were up 2% to $369 million. And that was driven almost entirely by their core North American La-Z-Boy branded business. The adjusted operating margin hit 8.1%.
Which is a 160 basis point improvement from last year.
A very strong improvement.
So if we strip out the 110 basis points from that warranty change, they still got 50 basis points of core operational improvement in wholesale. That's still really solid growth.
It is. And the CFO highlighted a key structural advantage they have that helps insulate that business.
Which is their domestic manufacturing, right?
Exactly. They emphasized that roughly 90% of their finished goods are produced right here in the U.S. and North America. In this environment of trade uncertainty and tariff talk, that's a huge deal.
It sounds great on paper, but I have to play devil's advocate. Doesn't focusing on the U.S. expose them more heavily to domestic labor cost inflation? Aren't they just trading one risk for another?
That's a great point, and it's a real challenge. But their argument is centered on control and flexibility. Labor might cost more, sure, but they get better lead times, better quality control, and they can pivot their inventory strategy much faster.
Advantages they feel outweigh the cost?
Especially for a premium custom-built product. It's a long-term play on brand and service quality.
Okay, so that's the strong part of the business. Now let's flip to the investment zones. Retail and Joybird.
Right. So the retail segment delivered sales were up just a tiny bit to $222 million, but the margin pain was real. Adjusted operating margin dropped from 12.6% last year down to 10.7%.
And that's all because of that fixed cost deleverage you mentioned?
Entirely. They're building and acquiring stores faster than customer traffic is currently justifying, especially with pressures in the housing market.
So it sounds like wholesale is the reliable old recliner that just keeps generating cash, and retail is the expensive new venture they're funding with that cash. Where does Joybird fit in?
Joybird, which is their direct-to-consumer brand, is still a small drag. Delivered sales were down 10% to $35 million.
Oh.
Yeah. And that lower volume led to more deleverage, so its operating loss actually got worse. They're still investing in it, but the e-commerce side is definitely struggling.
So the core business is funding the future. But none of this works without a strong financial foundation. Let's talk liquidity, because their balance sheet is remarkably strong.
Absolutely. It's rock solid. They ended the quarter with $339 million in cash.
Yeah.
And critically, zero externally funded debt.
Zero. In a high interest rate environment, that is a massive competitive advantage.
Huge.
I mean, you and I both know companies in this sector get sunk by debt when the market slows down.
It gives them so much optionality. While their competitors are paying huge interest bills or delaying projects, La-Z-Boy can self-fund this whole supply chain transformation, invest in new stores. They don't need to borrow a dime at these high rates.
That zero debt position is why they can afford all these friction costs we've been talking about?
It's the primary reason, yes. And that strength is reflected in their cash generation, too. Operating cash flow was exceptionally strong. $50 million for the quarter. That's triple the same period last year. It was driven by better working capital management and, this is an interesting detail, higher customer deposits.
Higher customer deposits. That suggests that even if traffic is choppy, the people who are buying are committing large sums up front.
Exactly. It shows confidence in the product, and it gives them a good order book, which helps fund operations internally.
But where's that cash going?
CapEx for the quarter was $20 million, all focused on the essentials. New stores, remodels, and pouring money into that big supply chain project.
And they're still rewarding shareholders.
Oh, yeah. They have enough confidence to increase the quarterly dividend by 10%. That marks the 5th straight year of a double-digit increase.
That discipline really speaks volumes.
It does. They returned $31 million to shareholders year to date, which is right in line with their long-term target. Reinvest 50% of operating cash flow back into the business, return 50% to shareholders. It's a very disciplined plan.
Okay, so that financial strength is what's underpinning this huge strategic bet.
Yeah.
Let's move to the future guidance and this crucial trade-off they're making. What's the outlook for Q3?
Q3 sales are expected to be between $525 and $545 million, so that's, modest 1% to 4% growth, but the operating margin is forecast to be noticeably lower.
How much lower?
They're guiding to a range of 5% to 6.5%.
A drop into the fives. Wow. That signals they're expecting some serious short-term pain. Is that just more of the same transformation friction costs?
It's actually twofold pain, according to the CFO. It's the continued supply chain friction plus costs related to what they call portfolio optimization.
Which means getting rid of stuff.
It means getting rid of stuff. They're actively shedding non-core, lower-margin businesses, like some of their case goods lines, and dealing with the closure of their UK facility. They are literally burning cash to shed inefficient waste.
So this is the massive strategic trade-off. Short-term volatility and a smaller top line today for structural stability tomorrow. Let's get to the most important number of all. What is the net financial result of all these moves? The acquisition, the exits, the closures?
This is the calculation that defines the whole quarter, really. They expect the combined impact of all these changes to result in about a $30 million decrease in annual sales.
They are deliberately choosing to be a $30 million smaller company. That is a tough pill for any public company to swallow unless the payoff is astronomical. What is the payoff?
The payoff is substantial, and this is the whole point of the Century Vision strategy. Shedding that $30 million in inefficient sales volume is expected to yield a significant and, they believe, permanent adjusted operating margin improvement of 75 to 100 basis points.
Across the entire enterprise.
Across the entire enterprise moving forward.
75 to 100 basis points of permanent margin gain. That's huge. That fundamentally resets the profitability structure of the entire company. They're prioritizing quality of sales over quantity.
Exactly. They're shedding volume that just wasn't profitable enough to justify the capital and the effort. It's a classic case of using balance sheet strength to drive an efficiency-first agenda.
That really brings us to the synthesis of this whole financial narrative then.
It does. La-Z-Boy is absorbing these aggressive short-term friction costs and even deliberately shrinking its sales base.
All in order to execute these structural changes that promise substantial, high-margin, long-term profitability improvement.
It's a classic move. You use a period of economic uncertainty to clean house and rebuild the backbone of the company. They are sacrificing top-line ego for bottom-line reality.
Which sets them up to be a structurally more profitable company once market demand eventually comes back.
That's the bet.
Which raises an interesting question for you to consider. Given La-Z-Boy's commitment to increase its permanent operating margin by shedding $30 million in annual sales, what industries you follow are facing a similar calculus? When is less revenue the clearer path to greater, more sustainable profitability? Thank you for diving deep with us today.